Welcome to TradeTheMBA.com. This is John's Reports for the 17th of February. Well, despite all of the liquidity and everything that the Fed is throwing out, we get the nice little X2s, which was the higher pivot of the red DOC, but just the other day we ended up with steel crossing below cyan and green crossing below red. That should produce some weakness. Now, we're not seeing a spike in orange, so maybe it won't be much, but again, I think that we're likely to see us come back to test areas around the EBM yellow and see if it then, it expands from there or not. The amount of liquidity, of course, the virus issue is still lingering in the background, but I think the market is convinced that the Fed will throw anything at it money-wise, so that's been enough for the last couple of months to keep things really pushing. It started with the repo thing back in the early part of December when it was recognized that the banks were putting a squeeze on lending to some of these institutions because they were recognizing the systemic fears. But you still have growth, and the big question will be, and we'll look at it in a minute, is oil, because if oil continues to drop, that is going to definitely impact the Midwest sector, because there's that fine line between where it's cheap for everybody else, but then problematic for the Gulf states and all the oil-producing states. So we'll see where that falls out. But you can also recognize we have a fairly weak shakeout here. I mean, we're not that far off the zero line. So the fact that we're at higher highs and seeing that kind of breakdown, it's going to have to really start to produce a significant move. So definitely worth keeping an eye on and being more judicious about long setups at this particular point. The difference is the NASDAQ, much stronger because you have a full reset of the steel. The issue is just new money coming in, but that's not such a big deal when you have this unlimited free borrowing that's going on right now at discounted rates and continued rise in the market. We haven't seen any what you might call outliers, deviations. I mean, the worst move we had was the other day where we dipped down and that was bought up swiftly. So nobody's under pressure to have to sell or do anything. This is problematic. And then you had a negative situation out of Britain as well to compound it, where the disagreement between Trump and Boris about the Huawei and whether or not it's a good thing for them to be China supplying Britain with the 5G setup, given the Five Eyes surveillance and that the U.S. does, and the U.S. believing that they're an arm of the Chinese government's intelligence. So that put a halt on trade deals, and Britain really isn't functioning with a lot of those, despite the fact that it's kind of in their best interest to do so. You then have the EU, which is just suffering immensely from the reduction in China's demand, because it's going to affect Germany big time with the auto exports, not to mention the tourism. You're already seeing that in Italy throughout, and it's really going to impact it. You're not going to have these mass number of Chinese tourists that really flood into Europe and help support its economy. So there's going to be a drawdown in a lot of these aspects. You may even see the EU move into negative territory as far as growth and everything else, which it already was pretty much flatlining. This isn't going to help. And you're right at my blue line here that we've had for quite some time as a warning point. So shock that we came to it. We expected it. We just thought it would happen sooner. That Brit exit thing kind of gave a lot of euphoria and stuff, but now they're realizing that there's some bigger issues, which we already knew. From an oil standpoint, this slight rebound is helpful, but we've really got to get past that 23%. The damage is still here in the shakeout. We're just getting to that ebb point where it could be above, but then we just had the break of cyan over the green right at that critical point. We'll see if the red DOC is enough to push that through. But with already seeing yellow right there indicating that we could be getting into an overbought while reaching the 23%, that's not what I call encouraging from a long standpoint. And of course, safe haven of gold. We knew this would be coming back up here with this setup has been always very bullish from that steel, maintaining that there's just plenty of liquidity there to buy up any dip. From an intraday standpoint, we still ended up with some decent short setups, some nice little intermediate longs. You can see that this one, as it started up with a nice piece, but then we immediately got this setup here where we ended up with the steel crossing below. I'll go ahead and put the marker right there, so if you want to go back to your chart, you can identify with it. where you get the little spike up, everything starts crossing over. And even if you wanted to wait a little bit longer, I would have been, from my standpoint, anything above the 50% that was still showing weakness, I'd be attacking. That's just the way I like to approach this kind of a setup, because it's going to take 3 or 4 bars, which in this case it only took about 3, and then boom, the cascade begins. And of course, in this particular scenario, it was just to move all the way back to the 100%, and then you had some follow through weakness that was going in, but then the DOC started building, and you didn't have a reset of the steel. Closest thing we got was this pivot right here, and then we came back down again, and then boom, you have the stronger one right here where the gold is popping. At the same time, you got all the marquee items. And then, of course, the DOC spread, which did lead to a retrace, but only back to the 23% before putting in the nice clean signal right there. And this is where you had your reset back below, crosses back above, at the same time green's crossing up there, orange dipping below, and boom, that went from the 50 to the 100. Like clockwork there. So no objections to that one whatsoever. It was interesting from a volatility standpoint, back and forth. And I think we're going to see a lot more of that. And I think that's going to be an exciting aspect, because whether you're even doing put options versus call options, you're able to do both scenarios. Still some stocks, I think, of course, your big names are still going to be moving a higher ratio to the market. But I think that as soon as there's trouble, the NASDAQ will be the place to be, because that has been the extended run. And so any potential extended events, because when we look at things from a probability standpoint, and you think about the fat tail capabilities of what could go wrong, the big fat tail is the virus beginning to show exponential growth outside of China in a variety of countries, and a lot of them are very concerned. I have friends in the Philippines and a variety of other countries that end up with a lot of tourism and things like that, and they're really not wanting to discuss it, which could be problematic for its spread. I know we ended up with those Japanese individuals that turned out to be infected in Hawaii, and they're asking if they should, people who were in contact said, well, should we self-quarantine? And the government says, no, just go about your normal day. So when you hear stories like that, it won't take long. But again, I always said that it wouldn't be until March or April before we would start to notice if there was any real breakout, because it does take that long to start building up enough systemic cases and get a broader view. Because we still, unfortunately, can't trust the information we're getting out of China. It's just sketchy. But what we do know coming out of China empirically is zero traffic, zero pollution relative to what it used to be. These are indications that there's zero demand. You've got the force majeure that's taking place on some of their contracts with metals, and it's going to happen with oil. We're seeing massive backups of oil tankers in the South China Sea, and so this is an indication that there's little or no growth. That is going to have a ripple effect. Now, will the Feds throwing money at it be able to keep the market from collapsing? Possibly, but that doesn't necessarily mean that the underlying economies of businesses that do business with China aren't going to be impacted, and that's going to start to have an effect here if there's a prolonged effort. I know the Chinese are going to be anxious to get everyone back, but can they? Will they? Or if they're not able to within, we're passing the time period where you would think that the incubation is passed, they should be going back to work if it's not as bad as, at least if it's what they're describing it as being. So these are some real things that you have to pay attention to going forward, whether it's about applying protection with, if you're serious long positions but don't want to sell, long-term protective puts as a married put kind of combination. A lot of strategies like that can still allow you to profit from the upside if there's going to be a continuation of growth, or give you security if there is this breakout moment. And we're going to start to see it. I would say the beginnings of seeing it, or what we're looking at, the market rising with our lower readings. That's an indication to me that bigger fish are selling into that setup. We'll see if it continues or if they end up buying back into the setup. But as it is now, I think that you get some warning signs. So we just have to see if they turn into full flag situations where we get the red flags, and we're able to say for definitely that we're looking for a bit more of a drawdown effect. So that's the broad macro micro situazione, as we say here, and I will certainly keep you updated on anything that we see developing on the bigger charts as we move along. But as always, trade well, and I will certainly put up any charts on Skype chat, so be looking there. Trade well.